Have you ever looked at a stock, one that everyone's talking about, and just wondered, is this actually a good business? Well, we're about to decode that language for you. And by the end of this, I promise, you're going to have a simple but really powerful toolkit to check out any company's financial health. No finance degree required. So let's start with a really basic question. When you click that buy button for a stock, what is it that you're really buying? Because it's so much more than just a ticker symbol bouncing around on a screen. And the answer, it's actually super simple, but it's also profound. You are buying a small piece of a real, living, breathing business. And look, just like you'd want to know if a local coffee shop is making any money before you invested in it, you've got to understand the financials of the companies you own a piece of. Now, the good news is you don't need to be some Wall Street genius to figure this stuff out. All you need is a simple 3-question toolkit. First, we're going to look at the profit story. Is it actually profitable? Then the stability story. Is the company stable enough to last? And finally, the cash story. Does it generate cold, hard cash? This framework right here, this is going to be our guide. All right, let's dive into that first big question. Is the company profitable? To answer this, we're going to turn to the first of the 3 big financial documents, the income statement. You can think of it like the company's report card over a certain period, say for a quarter or a full year. The story of the income statement always starts at the very top with something called revenue. This is just all the money a company brings in from selling its stuff before a single cost is taken out. Let's say you run a lemonade stand. Your revenue is simply the total amount of cash people hand you for your lemonade. That's it. It's the starting point. But, and this is a big but, a huge revenue number can be really deceiving. I mean, take a look at this. In 2023, Walmart brought in over $600 billion in revenue. That just dwarfs Apple. But does that automatically make it a better business? Absolutely not. See, revenue tells you nothing about the costs. And that brings us to the next level down, gross profit. This is what's left over after you subtract the direct costs of making whatever you sell. Accountants have a term for this. They call it cost of goods sold, or COGS. So back at our lemonade stand, this is your total revenue minus what you spent on the lemons, the sugar, and the cups. This is the first real sign of how profitable the business actually is. And this is where things get really interesting, because you can see how different business models work. You've got Microsoft selling high-margin software. It keeps 69 cents of every dollar it makes after those direct costs. Why? Well, once the software is written, it costs almost nothing to sell another copy. Now compare that to Ford. It keeps less than 10 cents for every dollar because every single car needs steel, glass, and a ton of labor. It just goes to show you, you can't really compare these numbers across different industries. So, after you pay for everything else, we're talking marketing, salaries for your employees, rent, interest on any loans, taxes, what is actually left? Well, that's called net income. You probably heard it called the bottom line. At our lemonade stand, this is the money you can finally actually put in your own pocket. This is the number that truly belongs to the owners of the business. You know, at the end of the day, profitability isn't about being the biggest company on the block. It's about being the most efficient. A company's ability to turn $1 of sales into real profit for its shareholders, well, that's the ultimate scorecard. And that wraps up our profit story. Okay, let's move on to our second big question. Is the business stable? For this, we need a totally different document. It's called the balance sheet. Now, if the income statement is like a video showing performance over time, the balance sheet is like a single photograph, a snapshot of the company's financial health on one specific day. The balance sheet basically has 2 sides that tell a really simple story. On one side, you have assets. That's everything the company owns that has value. You know, things like cash in the bank, inventory on the shelves, buildings and equipment. And on the other side, you have liabilities. That's everything the company owes to other people, like bank loans or bills that hasn't paid yet. And these 2 sides, they're always connected by what's called the golden rule of accounting. Assets equals liabilities plus shareholders' equity. Now, that equity part, that's super important. Think of it as the company's net worth. If the company were to sell everything it owns and pay off all of its debts, whatever is left over, that's the equity. That's what belongs to the owners. Okay, so one of the most vital questions the balance sheet can answer is about something called liquidity. And that's just a fancy word for, can the company pay its immediate, short-term bills? To figure this out, you compare what are called current assets, things that can be turned into cash pretty quickly, to current liabilities, which are bills that are due soon. It's exactly like comparing the cash you have in your wallet to the rent that's due next week. If your bills are bigger than your available cash, you're in deep trouble, and it doesn't matter how profitable you might look on paper. And please don't ever forget this point. A profitable company can absolutely still go bankrupt if it can't pay its bills. Stability is the foundation. It's the bedrock that allows a profitable business to actually survive and thrive for the long haul. All right, this brings us to our third and final question, and honestly, a lot of the world's best investors believe this is the most important one of all. Is the business cash rich? To find the answer, we need our third document, the cash flow statement. This is where we separate what's just an accounting opinion from cold, hard cash fact. So the first key number to look at here is operating cash flow, or OCF. Remember net income from the profit story? That number can get a little fuzzy with all sorts of accounting adjustments for things that aren't actually cash. Well, OCF cuts through all that noise. It shows you the actual, physical cash the company generated from its main business. It's a much more honest look at what's really hitting the bank account. But we can get even more precise, and that's what the metric called free cash flow, or FCF. Warren Buffett has a great name for this. He calls it owner's earnings. It's the cash that's left over after a company pays for all its day-to-day operations and makes the necessary investments to maintain and grow the business. This is the truly spare cash that can be used to reward shareholders, maybe with dividends or by buying back stock. And just to show you how powerful this number is, just look at this. In a single year, Apple generated nearly $100 billion in free cash flow. I mean, just let that number sink in. That is an almost unimaginable amount of surplus cash that's available to pay dividends, buy back shares, or snap up other companies, all without having to borrow a single penny. This comparison right here, this is the ultimate test of a business model. Take a look at Visa. It's what we call an asset-light business. It's a digital network. For every dollar in sales it makes, 60 cents turns into pure free cash. It's a cash machine. Now compare that to Ford, a capital-intensive manufacturer that has to constantly pour money back into factories and heavy equipment. Only 4 cents of every dollar in sales is left over as free cash. Now both are very successful companies, but one is just a vastly more efficient cash-generating machine than the other. It really all comes down to this one simple truth. Profit is an opinion, but cash is a fact. See, companies can use accounting rules to say they've earned money even if the cash isn't in the bank yet. But you can't fake the bank balance. A truly great business doesn't just report profits, it absolutely gushes cash. Okay, so let's tie all of this together now. We've looked at 3 different stories, right? The profit story, the stability story, and the cash story. And they're each told by 3 different financial statements. Each one gives us a unique and totally vital piece of the puzzle. So here it is. Here's your simple, repeatable financial detective checklist. First, you look at the income statement for the profit story. Does it make money efficiently? Then, you turn to the balance sheet for the stability story. Can this company survive the tough times? And finally, you check the cash flow statement for the cash story and ask, is all that profit actually real? So there you have it. You now have the 3 essential questions to ask. You know which document holds the answers, and you know what to look for. So the only question left is, what story will the next company you research tell you?